Hi everyone, I'm Ava and welcome back to your financial journey. When it comes to the economy, there are a number of things people fear. Excessive inflation, stagnant growth, high unemployment. But what might be more dreaded than any one of those things is stagflation, or all of those things combined. Stagflation is one of the most feared economic conditions in the world. It can cost people their jobs, bankrupt businesses, and take years for a country to recover from. But even though the mere mention of stagflation can cause panic, it isn't always that well understood. So today, we'll dive into what stagflation actually is and why it's so hard to combat. Specifically, we'll be answering these three questions. 1. What is stagflation and why is it so feared? 2. What caused stagflation in the 1970s? 3. Could stagflation happen again right now? Let's get started with our first question. What is stagflation and why is it so feared? As you may have guessed, the word stagflation is just a combination of two other terms, stagnation and inflation. So to answer the question of what stagflation is, let's first break down what stagnation and inflation are. Stagnation refers to a period when there's little or even no growth in an economy, which results in high unemployment and little investment. Inflation, on the other hand, is when there's a general increase in prices throughout an economy. Some inflation, say a 1 to 2% annual inflation, is normal and healthy in an economy, but too much inflation can make it hard for people to afford things and increase the cost of living. So stagflation is a combination of these two phenomena. The economy stops growing, or even shrinks, while at the same time, the unemployment rate and prices climb. Normally in an economy, these three things, low growth, high unemployment, and rising prices, don't all happen at the same time. Because if there's high inflation, it's often because demand is high, meaning that people have money to spend and that businesses are hiring. That spending and hiring leads to high growth and low unemployment rates. And on the flip side, if there's low inflation, it's often because there's low demand. That means that people probably aren't spending a lot of money, and that businesses might have to lay off workers because they're selling less. In other words, growth is slow and unemployment rates are high. But stagflation throws that rule book out the window. Even though no growth is happening in the economy, people have to pay more and more for things like gas, groceries, and rent. And at the same time, there aren't any increases in wages to make up for it. If anything, there's wage cuts and worker layoffs. That, in turn, means there's less money being spent in the economy, so businesses face reduced earnings and the risk of bankruptcy. And when people are pinching pennies and businesses are struggling, there's hardly any money to invest that could fuel new growth. The entire economy can be thrown in a rut, with seemingly little prospect for recovery. That's why this combination of high inflation and slow growth is so feared. There's no straightforward way to fix it. The usual tools to fix inflation, like raising interest rates to make borrowing more expensive, which can bring down spending, tend to make the economic slowdown even worse. Meanwhile, the usual tools to fix stagnation, like lowering interest rates to make borrowing money cheaper and encourage spending, risk making inflation even worse. Stagnation puts central banks between a rock and a hard place. If they raise rates, they might crash the economy. But if they lower rates, they might amplify already runaway inflation. That's why economists call stagflation a policy trap. Any move a central bank takes might just make something else worse. So stagflation is so hard to solve because of an economic slowdown and rising prices happening at the same time. But how does this situation of simultaneously having slow growth and high inflation occur in the first place? That's the question we'll be answering in the next part of today's video. What caused stagflation in the 1970s? To explain what actually causes stagflation, let's take a look at the best known and perhaps most extreme instance of stagflation that happened in the real world, and that was the stagflation of the 1970s. Before the 1970s, most economists didn't even believe that stagflation was possible. At the time, there was a lot of belief in the Phillips curve, or the economic theory that there was an inverse relationship between inflation and unemployment, meaning that if inflation was high, growth would be too, leading to low unemployment, and if inflation was low, growth would be low too, and unemployment would be high as a result. In other words, it wasn't possible for inflation and unemployment to be high at the same time. Keynesian economics, an economic school of thought based largely on favoring government intervention in the economy, particularly to combat economic downturns, was pretty popular at the time too. So a common idea was that if low demand and high unemployment became a problem, the government could just increase spending to offset that lower demand, bringing unemployment down. But that consensus changed in 1973. That October, a coalition of Arab states had attacked Israel, triggering the Yom Kippur War. In response, the US quickly sent massive amounts of aid to Israel to help them in the war. But the Arab coalition had its supporters too, including many of the countries that made up OPEC, or the Organization of Petroleum Exporting Countries. OPEC was a group of, perhaps obviously, oil-producing countries that produced nearly 50% of the world's crude oil at the time. And to take advantage of its massive share of global oil reserves, its members strictly controlled their oil production and prices. By controlling supply, OPEC could exercise a massive influence on the price of oil in the global market. So when the US supported Israel, OPEC, which decidedly did not support Israel, placed an oil embargo on the US. Because the supply of oil was drastically cut, the price of oil rapidly increased and made things more expensive than they had been before. Within months, gas prices in the US had quadrupled. Unfortunately, people couldn't just drive less to avoid paying those higher costs. Because oil is essential to modern economies, not just for cars and trucks, but also for heating, electricity, transporting goods, and producing plastics and chemicals. The importance of oil in so many processes meant that companies couldn't just cut corners. They still had to use as much of it as before, and they passed these higher costs on to consumers. So when oil prices rose, the cost of virtually everything rose as well. And even while companies were raising prices, they had to cut production because of just how expensive things were, slowing growth. That meant that inflation and unemployment rose together, and the economy hardly grew at all and even started shrinking. As economic conditions worsened, families struggled to afford the basics, and businesses laid off workers just to stay afloat. In fact, between 1973 and 1975, inflation in the US reached over 10%, and at the same time, unemployment rose over 8%. The US's GDP, a measure of economic productivity, fell as well. The government and the Federal Reserve, or the US's central bank, tried to help the economy recover. The only problem was that policymakers based their decisions on the Phillips curve and Keynesian economics, which made things worse instead of better. What they did was cut interest rates and increase government spending in the hopes that more spending would fight unemployment. But those moves only made inflation worse without doing much to alleviate unemployment. It was only at the end of the decade that the stagflation finally began to recede. That was largely thanks to Paul Volcker, who became chair of the Federal Reserve in 1979. Volcker made it his mission to kill inflation, whatever the cost. He raised interest rates high. The federal funds rate reached first 12% and eventually a little over 19%. The increased cost of borrowing slowed the economy even further. Consumer and business spending was reduced, and in 1982, unemployment reached 10%. But the Volcker shock produced its intended effect, because for all the pain, by 1983, inflation had been brought back down to 3%, and credibility had been restored to U.S. monetary policy. Other factors contributed to the end of the stagflation too. Oil supply once again increased after OPEC lifted its embargo in 1974 and other countries increased their production, bringing prices down. At the same time, the US deregulated certain industries like energy and transportation, and new technologies began to be adopted throughout the economy. Those two things increased worker productivity and helped the economy grow without fueling inflation. So by the mid-1980s, it looked like the crippling stagflation was finally over. Inflation had been brought under control, unemployment was falling, and the US economy entered a long period of economic growth. So what actually caused the stagflation? Was the entire economic disaster caused by OPEC's embargo? The answer is yes, kind of. The embargo was what led to the spike in oil prices in the 1970s and the resulting inflation. But the oil shock wasn't the only reason for stagflation. It revealed deeper vulnerabilities in the US economy. That included interest rates remaining too low for too long and high government spending on things such as social programs and the Vietnam War, which all contributed to inflation. Those factors meant that the global economy wasn't agile and was vulnerable to shocks. And when a shock finally came in the form of OPEC's oil embargo, it triggered the rest of the crisis. Since then, economists have found three major factors that can contribute to stagflation. 1. Supply shocks. If there's a sudden disruption in the production or supply of a resource that's crucial for the economy, like the OPEC embargo, which massively reduced the global oil supply virtually overnight, it can trigger inflation as businesses increase prices to make up for the higher costs. 2. Misused monetary policy. A country's monetary policy not matching its economic conditions can have disastrous consequences on its economy and make problems worse. For example, when the Federal Reserve kept interest rates low in the 1970s while inflation was increasing, it only made the rising prices worse. Mismatched monetary policy is never good, but it can be especially problematic in times of stagflation because of how hard it is to respond to shocks that increase prices. Even if central banks raise interest rates to try to limit inflation, they can't do anything about the increased cost of that material, meaning inflation is likely to at least some degree. And finally, 3. Structural inefficiencies. Other inefficiencies in an economy can make it more vulnerable to stagflation when a shock does hit. These include things like declining productivity, overregulation, and labor shortages. So supply shocks, misused monetary policy, and structural inefficiencies can all contribute to stagflation. When these things are observed in an economy, it can cause alarm and feelings that stagflation is imminent. And increasingly, there's alarm that stagflation might be happening again, despite the fact that the US economy looks pretty healthy on the surface. And that brings us to the next part of today's video. Could stagflation happen again right now? As we just covered, there's a lot of factors that can contribute to stagflation. But usually when stagflation happens, it's triggered by some sort of supply shock that raises prices while slowing growth at the same time. And recently, people have begun to fear that there will be a supply shock, or rather, several supply shocks, from President Trump's tariffs. Though we have yet to find out exactly how high President Trump's tariffs will be for which countries, or the precise effects new tariffs will have on the US economy, it does seem pretty certain that some higher tariffs will be imposed. And the fear is that those tariffs will lead to higher prices while stifling growth, resulting in stagflation. That's because tariffs make imported goods more expensive, and imported goods are a significant part of the US economy, as manufactured goods, but also as materials for a number of industries. So imported consumer goods will get more expensive, and countless other goods will likely get more expensive as companies pass on the higher costs of materials, resulting in inflation. And at the same time, new tariffs will almost certainly result in some sort of retaliatory tariffs from the countries they're imposed on, which would make it more expensive for people in those countries to import American goods. As a result, American businesses and industries that export a large share of their goods could see their sales reduced while also having to deal with the higher cost of goods at home, potentially leading to slower growth and higher unemployment. If those things, inflation, slow growth, and high unemployment, all happen as a result of President Trump's tariffs, we could see stagflation. Again, whether we actually see stagflation or not will be dependent on the ultimate extent of President Trump's tariffs and the precise effects they'll have. But there are valid reasons to be aware of it right now, which is why people have been looking at other economic signals that could provide hints. One thing that's been looked at a lot is the inflation rate. As of March 2025, the annual inflation rate in the US was 2.4%. That's not quite the Fed's goal of 1 to 2% inflation, but it certainly isn't a runaway rate. The only problem is that it would take time before the effects of tariffs are felt. So even if they do lead to significantly higher prices eventually, it might take some time before we realize it. Another measure that's been under lots of scrutiny lately is consumer sentiment, or how confident consumers are in the economy, because it can be a key indicator of future spending behavior. That's because if consumer sentiment is low, if consumers think the economy is going to get worse, they'll likely cut back on spending, which would then reduce actual growth. Talk about a self-fulfilling prophecy. And consumer sentiment hasn't been too great lately. According to the University of Michigan's Index of Consumer Sentiment fell for the fourth straight month, plunging 8% from March. That negative outlook could be an indicator of growth slowing. But it could also still change, and it's too early to tell exactly what impact consumer sentiment will have. As for unemployment, it's been going up over the past few months, but only very slightly, and definitely not high enough yet to signal a possible stagflation. That said, unemployment, even more so than inflation, is what economists call a trailing indicator. That means that it takes some time before the effects of a bad economy will be visible in the unemployment rate, and it may just be too soon to see them already. So could stagflation happen again right now? The short answer is yes, and there are some risk factors out there that we should be watching. But the longer answer is that there are always numerous factors that impact the course the economy takes, and nobody is certain whether, if we take it all together, they'll result in stagflation or not this time. It's possible that Trump's tariffs lead to rapid inflation and stifle growth, resulting in stagflation, but it's certainly not a guarantee. It's also possible that inflation remains moderate and U.S. businesses continue to expand, resulting in a growing and healthy economy. Right now, at the time of this taping, only the index of consumer sentiment might be signaling possible stagflation, while inflation and unemployment seem to remain under control, at least for the time being. Only time will tell. Stagflation is a significant economic threat, and while it might be rare, it can cripple an economy and massively impact people's lives when it actually happens. But the good news is that the better we understand stagflation, the easier it is to prepare for it. That's why the most important thing right now is to just be aware of what's happening in the economy and not panic. Because though stagflation might be a problem, it's too early to tell anything yet for sure. That's all for today's video about stagflation. So what do you think? Will we see stagflation soon? Why or why not? Drop a comment below to let us know. You can also check out this video here if you want to learn more about how tariffs actually work and why end consumers like us don't always have to shoulder the full burden. Be sure to like and subscribe if you enjoyed today's video. Thanks for watching, and we'll see you again soon.